Good afternoon, everyone. Welcome to the fourth episode of the Flying with Phoenix speaker series hosted by LTF Ventures here at the University of Chicago. LTF Ventures is a student-run VC found affiliated with the Postkey Center. And the Flying with Phoenix speaker series is a speaker series we launched recently where we invite top investors, business executives, and startup founders to come and share with the Chicago entrepreneurial community about their experience and their outlook on the global economy and business. And today it is our great honor to have Fabrizio Gallo of Fab Gallo with us for this event. So nice to have you here, Fab.
And thanks so much for David for having me. I really appreciate the invitation. Looking forward to the chat.
Great. I guess before we jump into all those wonderful questions that people have submitted from the past and as well as those that might be collected along the way using the Q&A functions in the Zoom chat box. I just want to give a little bit of introduction of Fab's bio so that some context for our discussion. So most recently, Fab was the head of global equities at Bank of America Merrill Lynch from 2011 to 2020. Since then, he has been busy with 3 marathons and pursued entrepreneurial interests at a late-stage AI fintech company. Prior to Bank of America, Fab was a partner and head of equities at Brevin Howard Asset Management for 2 years. And before that, he worked at Morgan Stanley for over 15 years, where he served as head of global equities and global proprietary trading. Fab holds a Bachelor's of Science degree in accounting and finance from the London School of Economics, where he graduated in 1989. Again, welcome to LTF, Fab.
Great. When I hear you say 1989, I feel very old.
I guess the first question that I have is that for you personally, what is a bigger accomplishment? Serving as one of the longest tenured stock chief on Wall Street, or being able to run 3 marathons when you are in the age of 50?
It's a great question. I think the third marathon was very recently. It was in Jerusalem, and it was really, really hard because it was very hilly and very warm. And it was the third one in like a couple of months. I think that was definitely the hardest thing I've done, probably ever. So I think you grow into the executive role and you have time to learn from your mistakes, but marathon's definitely hard.
So the marathon is a big accomplishment.
Yeah.
Are you planning on attending a few more this year? What's your goal?
I think my knees and my joints probably don't deserve another punishment, so I'll take it easy.
Great. I mean, I would love to be able to run marathons when I'm in the 50s. So that's great to hear. So Fab, when you graduated from LSE in 1989, how did you decide to become an equities trader? Was Morgan Stanley your first employer, or did you do a couple of jobs before you joined MS?
So when I graduated, I had no intention of becoming a trader or intention to have anything to do with equities. Actually, I really was interested in mergers and acquisitions, and that's something that I really wanted to do. But what ended up happening was I went back to Switzerland, where my parents are, for family reasons, and I actually started in a commercial bank.
Okay.
As an apprenticeship for 18 months. And then this particular bank called Swiss Bank bought O'Connor Associates, which was an option trading partnership based out of Chicago. So my association with the city of Chicago started a long time ago. And I started basically trading options in 1991. And I traded options on the trading floor, wearing bright collar jacket and shouting and doing all those things. Well, before technology, we were printing our vol sheets on large amounts of paper. Which was interesting because you were running out of paper and printouts when the market was moving a lot. And then in 1994, I joined Morgan Stanley. They were looking for a French trader and couldn't find one, but they settled for me, I guess.
That's great to hear. So you worked there, right, in MS for 15 years, and you rose through
Yes.
the ranks, and eventually becoming the head of global equities and global proprietary trading. What do you think are the factors most critical to your success in MS and I guess in your career in general? And I guess there are, stereotypes out there that for the trading profession, hard quantitative skills might be more important than soft personal skills. But what do you think of that? Do you think that your success rely more on the hard skills, so to speak, or the personal skills?
I think great question. First of all, I'm really privileged of having worked at Morgan Stanley. It's an amazing firm, and I was really lucky to couple of things happened. One is I was lucky to have a great boss at the beginning of my career, and because there was a lot of continuity, I was able to basically have the same person for almost all of the time I was there, in charge of my career, so to speak. So that was really lucky. The finance world was growing immensely at the time. It was the beginning of the globalization movement. There was a lot of sophistication and new financial instruments being created. And so there was a lot of jobs and, in a way, not enough people. And so that's usually a good position to be in as a graduate and as a junior in a large organization. That was definitely very important to the success. And then look, every time there was an opportunity that was coming along, sometimes it was a lateral opportunity. I always took it. I always took a little bit of a risk with the career, and again was rewarded. But it was a big bull market in the business and a big bull market as a firm. So I would say the beta was definitely a big component. I'm not so sure about the alpha, but definitely a little bit positive alpha contribution. And sometimes you find yourself in the right place at the right time. I guess starting in derivatives gave me the knowledge and the quantitative knowledge that was applied to lots of other initiatives. I think in terms of soft skills versus quantitative skills, I would say today it's slightly different than when I started. When I was on the floor, things like how big you were and how much you could shout were important skill set to have, which was always a difficulty for me because I'm neither. But I guess today, certainly knowledge of certain programming languages is key. I think that being very proficient in Python is a necessary skill today. I think it's a minimum skill that one has to have, certainly going forward, given the advent of machine learning and other things. And then I guess as your career progresses, I would say that your soft skill, quantitative skill mix changes. And obviously, if one becomes a manager, then other skills have to be learned, and you keep
Sure.
learning them throughout your career.
Yeah, it's just interesting to hear that these days you need to know at least Python in order to be in the business, which is quite different from your experience back in the 1990s. So I guess one of the questions that our audience have as a follow-up is, what do you see the role of technology in the trading business for the past 2 decades while you were in the industry? How has it changed and reshaped the industry during those years? For the better, for the worse? What do you think?
It has changed it in the sense that a lot of it has become more transparent. Mm-hmm. When I started in the mid 90s, early 90s, I think, for example, US stocks were still calculated in eighths and 16ths and 30 seconds. You had to stamp red tickets for sells and green or blue tickets for buys. You had stamping machines with clock machines on the desk. You had old style phones. You had faxes and telexes and things like that. Now, I think the transactions were mostly local. You had very little global. and you were measuring trading times in seconds, or even sometimes more than seconds. Now everything is in microseconds, and the number of transactions and the atomization of transaction is exploded. The market structure has changed as well. In the US with things like NMS, the market is totally globally. The stocks themselves are global. I think the S&P now, I think, is 70% foreign sales. I think when I started, the S&P was probably the opposite, 70% more US sales. So the drivers of the markets have changed as well. And I think technology has been a constant factor since the beginning of time, since the Phoenicians started trading derivatives on olive oil. I think it will continue to be a dominant factor. What I would say is the balance between hardware and software, between raw speed and softwares and programs that think about predicting movements. I think there's a lot of work and development being done there, which is very, very interesting. But I don't think it has changed either for the better or the worse. I think it's just a characteristic of the marketplace.
Right.
Like all things in life, I guess.
Yeah,
not just trading.
Only constant in life, I guess.
Yep.
Thank you for that insights. And if we look back to the late 2000s, you actually came out of the investment banks and joined Brevin Howard, which is a hedge fund with a global macro strategy. And some of their funds was based in Hong Kong, some of them in the US. What do you think are the commonalities and differences working at a buy-side hedge fund as compared to a sell-side investment bank, which you spent much of your career in? Which side presents a better career opportunity for a fresh college graduate, which are most of our audience today?
So I'd say a few things. Obviously, the sell side has changed a lot. It is further away from the buy side today than it was when I was active, primarily because after the global financial crisis, with the advent of Volcker, the proprietary trading desks of the sell sides were shut or were basically closed. And so the similarities between committing capital on the buy side for your LPs and committing capital on the sell side for your shareholders has changed over time. When I started in my career, there were a lot more similarities than there were differences. That's one comment. The second comment is, I guess the analogy I would make is probably something similar to, look, if you want to work in a hospital, you both have to go to med school. You both have to read the same books. But a surgeon and a hospital administrator, they're both doctors, but they do very different functions. And I think the buy side versus sell side is got some similar factors associated to that. Look, I think the buy side is a lonely place to be. Often you're in front of a screen with capital and you have to make decisions.
Right.
To buy and sell, and you use the sell side to help you navigate the markets as much as possible. And I think that what I would say, it's also a little bit like a sports analogy. If you are thinking in terms of the mean or even the median contribution, like salaries on the sell side, I guess it's there between $300,000 and $400,000 a year on average for the industry. That's pretty good living. And there are a lot of people on the sell side that can achieve that number over time. I guess the distribution of salaries is a little bit different on the buy side. You have to take more risks, but the reward are obviously higher. So I guess it looks more like the payoff of a call options as opposed to the payoff of a call spread, right, if I could put it that way. But I guess it also appeals to different people and different interests. I think also what I would say is the buy side is also becoming more institutionalized. When I started, to have $10 billion under management was a huge number.
Mm-hmm.
Now, if you look at places like AQR or Two Sigma or Citadel, D-Show, and so on, I would say that Millennium, for example, I mean, we're talking about 50, 100 AUM in billions before leverage. These are very, very large, sophisticated pools of capital that have amazing technology and amazing risk management systems and are very institutionalized in nature. So in that sense, starting one of these very, very large groups is very similar to having started at Morgan Stanley in the 90s and early 2000s.
So, despite all the salary differences, you're saying that because the buy side has been institutionalized so much and become a lot more like the sell side, the career opportunities, the way that you get to be trained and mentored and progress through your career are very much similar to the sell side these days.
In the older days, I think if you start on the sell side today, I would say that your first year or 2 years or 3 years is still a great school. It's still a great experience. It's still a great sounding board, and it's still something where you learn a lot. You're exposed to a lot of things, and so in terms of creating the foundations for your knowledge, and also as an individual to get to know themselves, it's a great place to be. Some people early on in life realize that they want to just be stock analysts, for example.
Right.
And they like to live in a quiet environment and read lots of research. They love meeting the management of companies, and those are the things that make them happy. Then I would say the buy side is probably a great opportunity. I also would say from a technology point of view, in a lot of buy side companies, you have a structure because of regulatory wise, it's easier to do. Whether you're a quant, a programmer, or a trader, I would say the differences between those three functions are a little bit blurred. Whereas on the sell side, you still have a trader, a technology person, a structurer, a quant. So I think you can definitely switch between being a programmer to becoming a trader easier on the buy side in certain groups, like Jane Street, for example.
You're less special than the sell side. Gotcha. So for you, you made the decision later on after spending 2 years on the buy side to go back to the sell side in 2011. You joined Bank of America. You stayed there for over 9 years as their head of global equities. And during those 9 years of your leadership, what was your proudest accomplishment, and what was the greatest challenge that came with it?
Bank of America is an amazing franchise. And I thought it was interesting that even though people compare, JP Morgan, Goldman Sachs, Morgan Stanley, Bank of America, they all sound similar. They all are sell side companies, but the reality is they're very, very different. When I joined Bank of America, the DNA of Merrill Lynch was very strong. And surprisingly, I had to learn a lot about new technology systems. And you're used after 15 years at Morgan Stanley, you're knowing every single person in the organization. You know everyone in treasury, you know everyone in accounting, you know everyone in technology, in compliance, in legal, and so on the sell side. And you have to start those things all over again. So I would say the greatest challenge was to be careful of just saying, well, it worked in a certain way at Morgan Stanley, therefore it has to work in a similar way at a different company. That's definitely not the case. The second comment would be to be inside a universal commercial bank, but inside an investment bank is also different as an experience. You have different regulations like Reg W, for example, that manages how retail deposits can be used for investment banking activities or not. And so there were a lot of things that I had to learn. So I think the greatest challenge was that. And the second greatest challenge would be you enter a company that has a certain culture that has made that company great. How much can you change the culture from within without creating too much noise and too much tension, and bring it to maybe more modern products, or different ways of doing things. So that was also a big challenge. In terms of keeping people or hiring people, that was an interesting challenge. And then the other challenge was, look, when I joined, Bank of America was emerging from the great financial crisis, countrywide situation, and so on. The stock was a difficult position because of the large fines. So it was difficult to regain the trust of the clients. And I think if I have to think about in terms of what I'm most proud of what the team achieved throughout those 9 years, because it's never one person, it's always a big team, I would say probably two things. One is that I would say today the clients feel that Bank of America is a great institution to do business with, and that we created a great team, which is still running a very, very good business and flourishing. So I would say those are probably the two things I'm most proud of.
Great. Thank you for sharing that. And let's move on to talk about something that's dear to your heart, which is trading and investment in general. I guess the first question that we have is, what is your overall investment philosophy? Do you pay more attention to the macroeconomic factors, including geopolitics, or do you pay more attention to industry trends or even individual stock fundamentals when you, I guess, invest on your own, but also perhaps as related to your career as a trader?
Yeah. So first of all, I will answer your question, but as someone who runs a very large sell side firm, activity in stocks, you often are very restricted in the amount of trading that you can do for your own money, because you are what is described as over the wall. So you know a lot of things about a lot of situations that the wider market might not know. So you give your money to someone else to manage on a purely discretionary basis, or you are in very prudent investments like treasuries, because you are, you're long the stock market through the job that you hold and the stock that you receive as compensation. But I think the most important thing about investing is, first and foremost, is a person has to decide, or a family or a household, you have to decide what kind of utility function you want to have in your investment, or what kind of risk tolerance you want to have, how much money you want to make, how much money you need, what makes you comfortable. And that's a surprisingly complex thing to do. So that's my first comment. The second comment is, I would say I was always brought up in a relatively macro rich environment. So I think that I remember one of my clients in the past, a very, very large and successful macro person, telling me once that equities were I think something like the flea at the end of the tail of the dog, so of the macro dog. So when the macro dog moves around the tail, then equities go back and forth. I think there is no doubt that one of the most important things in equities is the denominator. So how much money there is out there. The more money there is, the more money gets printed, the more likely are scarce investments to go up in aggregate. So that's one comment. Obviously, the more the economy, because this is a real asset and it's about protecting nominal wealth and mirroring the real economy, the more the real economy grows, the more it's positive for equities. A little bit of inflation is good for equities. too much deflation is bad for equities. So in general, also if you go back over the long term, it's a great place to put your money, especially if you're young. I think from the point of view of industries, I would say it's always the key is understanding how much growth is built into the earnings of the companies that are the most successful one. I think it's always good to understand the business and first buy into a business model and then look at the numbers after, as opposed to the other way around. Yeah, so those are some of the comments that I would have. But I guess the philosophy is always about doing your homework, buy the things that you like, truly like, as a business. If you have the chance, obviously, to get to know the management, even better. But there are stocks that are incredibly cheap on a number basis that are also not necessarily good businesses and they don't perform very well, and stocks that seem incredibly expensive and go up 100-fold because they're in the right business and have the right management. So yeah.
Great. Thank you for that very comprehensive overview of your investment philosophy. You mentioned just now that the equities market very sensitive to rate change and the money supply. So this very timely question from our audience that today the U.S. economy faces inflationary pressure and Omicron variant threatens the global supply chain. Do you think that the Fed should speed up its rate increase in order to combat inflation, or should it keep rates low in order to prevent a recession? How should they choose?
So what I would say is the following. Interest rates, real rates are negative by a lot. So the risk-free rate is below 2%, and depending on which time horizon you pick, we're talking about negative rates between 3 and 5%. Let's say 4%. That's a big number. It's a crazy number. So the first comment to make is you are also pricing equities vis-a-vis the risk-free rate, i.e. government bonds. I would probably say that equities at, let's say, 20 times earnings for the S&P are probably less expensive than long-term bonds are. I think the real issue, though, is slowly morphing into something else, which is the risk in keeping interest rates so low for so long as inflation becomes a social phenomena, not just an economic phenomena, is that eventually people start losing faith in the fiat currency and losing faith in the government bonds. In the old days, we had those things called bond vigilantes, which no longer exist because of the infinite QE policy of the central banks and the differential in firepower. But I think I would say that we are getting into a place where the last time we've seen similar situations were in, I would probably say, in the mid-20s. Which all the consequences that we know happened afterwards. So
right? Clarification.
Yes.
1920s.
1920s, yes, sorry. Hopefully not the 1820s. And so I think that at this point in time, I would say we're getting, hopefully, a small recession is okay, meaning if we can have negative rates that still help everyone, but not 3 to 5%, but maybe 1%, and that causes a correction in asset prices, I think that's probably a preferable outcome than the opposite, because I think we are running the risk of left tail scenarios here, getting bigger and bigger. That's my view.
Thank you for that. That's definitely a unique view. The first I've heard of. You mentioned that inflation are becoming not just the economic issue, but a social issue, the erosion of trust in government, in fiat currency, the institution. There's another big concern, the pending hanging bomb that people often talk about, which is debt and government debt, household debt, corporate debt, right, public and private debt, all of them. In in the US and globally are very high these days. One of our board member, Howdy, are asking, when we are seeing these historically high level of debt to GDP ratios on many levels across the globe, especially in the US, many macro investors warn that we are at the late stage of the debt cycle. People like Ray Dalio from Bridgewater always talk about this. What's your thought on this unprecedented level of debt in the global economy right now, especially in the US?
Yeah, I will say a couple of things. First of all, look, there's no way I can be in the same phrase as people like them. I am very pedantic in that sense. Of like, I have a couple of comments about that. The first one is, I don't think a high debt to GDP ratio in itself is an issue. Think of it a little bit as collateralized debt. I mean, if you have a mortgage against your property and it's a good house in a reasonable neighborhood, and you have a little bit of debt against your house, it's okay. I think, if the government can tax the population and can grow itself out of debt, those two things should hopefully be things to be taken into considerations vis-a-vis the well-being of the population. I think the risks here are two or three folds. One is, look, historically, inflation was a very, very good way for states to inflate their way out of sticky situations, primarily because inflating took care of most of the population, because the debt historically was in the hands of the poorer side of society. I mean, I'm being simplistic a little bit for conversation purposes here. But right now, I would say most of the debt is actually held by not necessarily the poorest part of the population, but the richest part of the population. And so there is a risk here that, if you buy $100 million house and you take a $80 million mortgage at 2.5% for 10 years, that's a pretty good anti-inflation strategy. Very few people can afford that. And so I would say that we have to look at it in aggregate. Like, we can't just talk about debt to GDP numbers without looking further into the money supply, and also, most importantly, the velocity of the money supply. I think people don't speak too much about the velocity of money. One of the things that has been dormant, obviously, is that factor, which I think is now accelerating because of inflation and consumer behavior. So that's something to think about. And then, where does that debt go? If the debt goes to productive means, fantastic. I think I would say places like mainland China would not have been able to take so many people out of poverty in such a short period of time without a high debt to GDP ratio. In other situations where we might have a much more aging, slow growing economy, that number might not be as beneficial as it has been in the past for things like China. So it's a delicate subject. I'm not a believer in MMT, but I'm also don't.
I'm asking you, Chicago are believers of MMT.
But I also don't think there are some parts of it that we should acknowledge and understand. I think the real debate will be when some of this inflation stops being transitory and we it's going to be very, like, we're going to have a very, very large deflationary impulse at some point in time. A lot of it is going to be a good deflationary impulse because it's going to be amazing technological developments that will be the result of this inflation period. Hopefully we don't have social upheaval or wars in between.
Yep, I hope so as well. And I totally agree with your analysis there. The debt to GDP ratio is one of many factors to look at, but definitely not the definitive one to determine whether or not we are in a healthy spot these days. So thank you so much for that insight. I guess just another question on trend investing. One of our board member, Howdy, asked about the place of active management fund in the face of rising popularity of passive management funds, such as the index tracking ETF that's been gaining popularity around the world and different exchanges. Can you comment a little bit about that? Do you think that active funds still adds value in today's world? I guess it does if we are indeed going into a deflationary cycle and asset prices are dropping. Maybe the active funds are the ones that makes money, while the index tracking ones are all losing money. What's your take on that?
I think that first of all, I would say if I am selling you a product that is passive in nature, i.e. has return and risk characteristics that are similar to a passive product, but I charge you 150 basis points a year, that's an issue. I think ETFs are a fantastic tool because by identifying the beta and pricing the beta in a very cheap manner, they are one of the things that have been great impulses in democratizing investment for people that could not have afforded before. So I think that's great. And I think ETF investing married together with the internet and simple tools have given the ability to a lot of people to manage their finances better. And so I think it's great that we have ETFs and passive. I think pricing alpha and selling the timing of beta, which is another form of alpha, and we call that active investing, probably has a bigger place than the last recent trends. But as you know, the last year was a crazy year in terms of equity inflows. We had a huge amount of equity inflows into the system, and that is good for both passive and active. And I agree with you. I think if the implied Sharpe ratio of the S&P goes down, then there is space for active. And if the expected variance of stocks goes up, there is also more room for active. Definitely.
Great. Thank you for that comment. As you said, right, ETF, they help democratize investing, made the stock market accessible to a lot of people. But with any democracy, there is the threat of populism. And in the investing world, I guess that manifests in the sense of there's meme stocks and those investors that are retail investors. They are small, but they bond together online through social media and other platforms to pursue collective actions. And we can see that from a year ago with Melvin Capital and the GameStop saga. And there are still a number of stocks these days on the market, including, I think, AMC, that are very much those meme stocks jacked up by retail investors banding together online. What do you think are the long-term effect of this trend of this so-called rise of populism in equity investing, where internet-enabled retail investors, they band together and pursue collective actions?
I think that so a couple of things. One is my sense is obviously shorting a particular stock in large size as a percentage of your portfolio and your LP capital can bring can bring great riches, but is a very, very risky activity. This concept of stocks going to infinity, so to speak, for a variety of different reasons is not new. Though, I've seen that happen a couple of times on stocks much more famous and much larger, like Volkswagen, Porsche, Stub, Ordinary, and so on during my time. So a short squeeze is not a new phenomenon. So I think that that's just one comment. The second comment is, look, meme stocks and so on, this is just another reflection of the impact that technology is bringing to the microstructure of markets. Right. And I think this is the beginning of, not the end of, a very, very powerful trend, which is about moving the power of who is going to be the marginal pricer of things away from traditional intermediaries and traditional agents to a much more decentralized system. And so I think we're all learning what that means. And like in any situations, you have extremes. I have no view about the intrinsic value of the AMC or those names. I mean, I do have a view, but I think stocks are very stocks are very volatile things. Stocks sit at the top of the capital structure, so to speak, or at the bottom, whichever way you look at it, and therefore are very, very volatile. The more proximate the underlying nature of the business, the more volatile those things are. The smaller the float, the more risky it is. I think Reddit and this whole concept of I would prefer using the word democratization than populism personally. Sure. I think it's fine for groups of people as long as it is done in a proper manner. I think that's okay, but I do think that the SEC will probably put some framework in place at some point.
Absolutely. Thank you for that. And you mentioned about decentralization of finance as a trend, and of course we have to touch upon cryptocurrency in our core, otherwise our audience will not be happy. So one of our students asked, Martin, he asked, some investors consider cryptocurrency a medium of exchange, which will eventually become a currency that transcends border and sovereignty. Others treat crypto more like an asset class that can be used to hedge against the systematic risk of the public market. Yet others think of crypto as purely speculative investments with potentially dramatic short-term gains. Which camp do you belong to, and what do you think the future holds for crypto in general? And last but not the least, I guess the most important question is, do you own any crypto yourself?
I'll start with the last, which is I own very little and very late. If not, I would not be in my apartment here, but I would be in a beautiful mansion somewhere in the Bahamas. I will say a couple of things, just taking a step back. First of all, throughout the history of currencies, we've gone through different regimes since the beginning of times, all the way going back to barter system. And so I think it's only natural, but it just so happens that we're living in the particular moment that with the evolution of technology, new solutions are found to how to provide means of exchange and commerce. And I think that's what crypto is doing. If you look at sort of the white paper on crypto. So that's the first comment. The second, I would say, when do new forms of payment and exchange in currencies happen? They usually happen either during times of war or they happen during extreme situations. And we are in extreme situations. We are in a place where rates went to zero, money supply went to infinity. I believe, might be slightly wrong, that between 30 and 50% or one out of every $2 has been printed in the last 2 years, something like that globally. You know, the $2.5 trillion of value or thereabout of the total crypto market is an exchange valve of things that probably might have gone into gold in the old days or other places. So so that's one comment. I think crypto is one word that encompasses a lot of things, all the way from, you know, stable coins all the way to NFTs for inexistent art. I think that the thing that is the most exciting and most potentially revolutionizing is definitely the decentralized space and the DeFi world. And I think the advancement in computing power and coding are something that I think the market is still getting to grasp with. And what does that mean to you know, the existing system? I think that what is unique this time is that crypto is not sponsored by governments. In the past, different currency systems were basically sponsored, so to speak, by government or changes in and driven by authorities, whereas now the drive is done bottom up from the roots of the population. That causes a couple of issues. One obviously is the whole concept about money laundering, but more importantly, I think modern states are built on 3 or 4 very important things: an army, taxation, among others, and not having the control of the currency is a big deal for governments. And I don't know where that will end up happening. And so I think it will be interesting to see where it goes. 1, 2, I think there is definitely a little bit of self-fulfilling prophecy so far in terms of the prices. It's very volatile, but I think it's here to stay. I think the technology is here to stay. And it'll be very interesting how it gets applied. Look, I think if interest rates move up substantially and quickly, we'll probably see some of the excess exit the system. But the technology, this concept of Web 3.0 is very, very, very strong and very, very exciting. So whether it's Bitcoin, Ethereum, Uniswap, Solana, there's lots and lots of layer 2 protocols. They are, I am sure, unique things that will change the way we think about commerce, the way we think about legal contracts, the way we think about market making. That will be, we are in the middle of a revolution, and I think that that revolution is here to stay. But whether Bitcoin will trade 20,000 again, possible, yeah.
So if I'm to put all of my tuition money into one crypto, which one do you think I should buy?
One with some very strange name. Probably you should launch a DeFi level 2 protocol.
Like LTF coin or David coin, right? Something like that. My own issuance. Thank you for that comment, and I definitely agree with you. I guess I have a follow-up question regarding volatility you observe in the crypto market space. Some people, some banks, investors, they justify holding crypto as a hedge against stock market risk. They're saying that the stock market drops, crypto rises, but I think recently the data shows that those two market moves more concurrently than they are opposite. Does that kind of empirical evidence kind of go against the whole theory that cryptocurrency can be a good hedge against macroeconomic risks?
I think that both crypto and stocks have one thing in common, which is there is a denominator which is in common. So if the blood of money supply creation gets drained from both, then they'll behave in similar fashion. And so I think the most, I think there's a lot of, what I would call long duration growth assets that are a very large part of market capitalized indices, i.e. Technology names that have relatively little cash flow and very, very high multiples, but are in very exciting growth businesses. I think they exhibit similar characteristics to crypto. There's no doubt, I think, that if there is less money supply and less fiat currency and higher interest, and the price of those go up, there will be other places for people to put their money. And so they will take it from stocks and potentially from crypto as well. So in that sense, I think that they can behave the same way. But I think as a running away from having cash, then I think crypto probably still is an interesting proposition. I think it's not by accident that what is considered to be risk-free interest rates in the crypto space, inverted commas, big inverted commas, probably are between 3 and 6%, depending on which platform and which construct you want to go in there, which completely by accident happened to be the number where real rates are 0.
Great. Thank you for that insights. I guess the last part of our conversation, I'm just going to touch a little bit around student career advancement and some of the common questions that we ask here among the audience. One of the questions is from Yi He, and I guess I'm going to combine them with another question from Wenling Ji, who are both among the audience today, and they're asking that what would be some of the effective ways for a student to get to know whether he or she fits a job in trading? As an econ major, which is the most popular major here in Chicago, with some knowledge of political economy, starting their career in the pandemic area, would trading be the function that fits them the best, or are there other ways for them to join finance?
Well, first of all, I think you're all very, very young and very, very bright, and in a great school. So I have encountered in my career incredible traders that had philosophy degrees. So I think today it's a little harder, but I think that even if you don't have a quantitative degree, learning Python is not too complicated for people of your generation. Look, on the sell side, there are lots and lots of places to start a career, from investment banking to global capital markets, and so on. I think the most important thing is the first year or 2 or 3 years, someone just needs to learn who that person is. I think very, very, very few people are actually born traders, and they grow up saying, this is what I want to become. Like, most people end up being a trader through different routes. And so I think that it does not necessarily matter which degree you hold. I think eventually you have to know whether you're an extrovert or you're an introvert, whether you like the instant gratification of numbers or you like human interactions. And those things, I think, are personal decisions and individual decisions. I don't have a generalized piece of advice. But whether you start on the buy side or the sell side, I think the biggest piece of advice is don't be shy. The first couple of years is all about learning and hard work.
Great.
That's my sense.
Thank you.
So there were a couple of
advice. So we're going to end with a couple of fun questions that we normally do as our guests, and the first one is from LTF board, and out of all the stock exchanges in the world, the New York Stock Exchange, the Nasdaq, very influential. In Hong Kong, the HK Exchange, obviously enormously influential in the Greater China region. if you were to set up an exchange of your own today, which city would you put it and why?
I would probably bet on the long-term prospects of mainland China and make the long-term bet that because the wealth creation goes through technology and the wealth creation goes through the happiness of the large population at large, that once this period of readjustment and giving back to the emperor, so to speak, is over, that still has the largest absolute scale future. And in that sense, I would probably pick Shanghai over Hong Kong. That would be my guess, long term. And the second place I would think of, it's completely opposite, is Africa.
Oh.
Because I think that that's going to be, and I think the combination of Africa and potentially decentralized architecture might also be a very interesting place to think about. I'm not sure whether that is Nigeria or the place, but the numbers in absolute terms will be smaller, but I think the growth could be exponential.
Oh, great.
Those would be the two places.
And for the first answer, you'll be glad to hear that I think the Chinese government agrees with you. I think Xi Jinping just opened a Beijing stock exchange a few months ago, in addition to the Shanghai and Shenzhen stock exchange.
Yeah.
So we'll see how big a growth it will be in the next few years. And the last question of today we're going to ask is, UChicago just welcomed its new CIO, Andy Ward from Boeing. Do you have, if you had to give one piece of advice for him who manages the endowment fund here at UChicago, what would that one piece of advice be?
Wow. You know, I mean, I don't think he needs any advice, but look, the magic number is 7%, right? Compounded 7%, a little bit more than 10 years doubles your money. So I think that how to construct portfolios to try to approximate that number over cycles is definitely the key consideration for an endowment. My sense is 2022 is probably a year to be a little bit more prudent than the average mean.
Yeah, last year they returned 30%. I think a lot of endowment was crazy last year. But you think that's unsustainable?
I think it's going to be a little harder for the same reason that you pointed out, that active asset management will be something to think about and focus on in the next year or two. I think we have a few situations in 2022, from midterm elections to other situations, where there'll be great opportunities, and I think to have a little bit more unencumbered cash on the side could be something to be slightly, you know, like that would be one of my focus. I think that would be probably my advice.
Again, thank you so much, Fab, for joining us today.
Thank you, David.
Thank you for all the audience and the wonderful questions. We truly had amazing, informed conversation about trading and your career. Again, thank you so much for coming in, Fab. This has been enormously.
It's an honor. Thank you so much.
It's our honor to have you, and I'll see you soon somewhere.
I hope so. Bye-bye.
Bye-bye.
Thank you.